Hey, my name is Rajesh. I am a DSCR lender based in Los Angeles, and I specialize in 2 to 8 unit multifamily homes. Today we're going to look at 2614 Garth Avenue. It's an 8 unit building for $2.1 million. That's a really good price. So let's see what we have over here as far as gross rents go. Gross rent multiplier 11.55. So what do they mean by gross rent multiplier? What is gross rent multiplier? The gross rent multiplier is a metric used in real estate to evaluate the value of an investment property by comparing its price to the annual gross rental income it generates. A lower GRM indicates potential for better investment, as it suggests the property will pay for itself in fewer years based on its rental income, suggesting that. So basically, they're looking at how many years it would take to pay off the building by just using the gross rents. So technically, to calculate it, it looks like you would have to divide the purchase price by the number, by the total gross annual rents. So let's see what it says over here. Rocket Mortgage does not worry about net operating income. It just looks at gross rents. So gross rent multiplier, fair market value, gross rental income. So that question mark is a divided by sign. So let's see here. So to get the reverse of that, you would, let's see what it would take to divide by 11.55. So that means, what, 18,000? No, that doesn't make sense. Does it? Let's see what that would look like. Going to do some quick math over here using rearranging these numbers. So price divided by gross rents is equal to GRM. P is equal to GRM times G. So P divided by GRM is equal to G. So that's saying it is 18,000. So this is saying $18,000. That doesn't make any sense to me, because there's no way annual gross rents would be 18,000. So yeah, that just doesn't make sense. 18,000. Let's see, 2.1 million divided by 100, 116. Maybe I entered it wrong. Divided by 11.55. 181,000. That makes more sense. Okay, so they are saying gross income is $181,000 per year. So let's go ahead and punch that in here. There's 8 units. It's got how many units vacant over here? The current with vacancy of 3 units. Current with a vacancy of 3 units. So they've got 3 vacant units over there. For 5+ units, we only allow a maximum of 2 vacant units. So this is already property we cannot approve of, despite the supposed $181,000 $1,000. So I don't know if this is a pro forma or the actual number. Let's see. Let's say this was 3 vacant units. $181,000 divided by 5 divided by 12. So that's telling me each unit is renting for $3,000 a month. That just does not make sense to me. I think in this area we're looking at somewhere between, okay, so 2 plus 2 plus 1, 1 plus 1. It might be $3,000 a month. Yeah, who knows? What is market rent here? Does it say market rent to 90034? Now normally we'd have an appraiser do this, but I do not have an appraiser handy right now, so we are going to look at other data here. Alright, so 1 bedroom is $22.33, studio is $18.65, 2 bedroom is $29.95, and a 3 bedroom is $41.08. So let's see what kind of bedrooms these are. 2 plus 2, so we're looking at $3,000 a month for each. 2 plus 1, probably $2,900, $2,800, something like that. So let's say $3,100 for 2 plus 2 and $2,900 for 2 plus 1. So we're, oops, wrong one right there. 2 plus 2 is equal to $3,100 each. 2 plus 1 is equal to $2,900 each. And then we have 1 plus 1. 1 plus 1 is equal to, what is a 1 bedroom going for? $2,233. $2,200 each. And let's see how much units they have of these. I believe this was a 2 and this was a 3. So we're going to just figure out the gross rents here based on these numbers. They might actually be earning less than that because they're currently occupied. So let's say 3,100 times 3 is 9,300. 9,300. Whoops. And then we have 2,900 times 2 is equal to 5,800. 5,800. And then we have 6,600 for this. So let's see here, 9,300 plus 5,800 plus 6,600 times 12 is $260,000 a year, gross rents. So, and they said they have a GRM of 11.55, which means they're closer to $181,000 a year. So looking at this, we can sort of figure out which units are vacant. 79,000, right? Now divide that by 12. And that's $6,500, $6,583, $6,600. That means these three are the vacant units here. So these are filled and these are vacant. It looks like the vacancy that we had, 6583, is pretty close to this. So it looks like the one-bedroom apartments are the ones that are empty, meaning $2,200 each, $6,600, and the other rents are what? $9,300 plus $5,800, $15,100. Vacancy discount just means we're only going to apply 75% of the $6,600 to the gross rents, because if this was 100%, the qualified gross rents would be $21,700. So it's actually going to be a little less than $21,000. Property taxes. Now here is the other thing about this building. Let's see what they say about meters and utilities. You got on-site laundry facilities, so that means you had to pay for that electricity and water and all those things. I don't see anything about utilities here. I don't even see anything regarding NOI, so it doesn't really tell us much. But let's assume 65, gas for the washer and dryer, electric for the washer and dryer, trash 250 is about right. Let's say we do 10% of rents for property management, maintenance, 10% right there of qualified gross rents. This is 8%, sorry. Pest control seems fair. Legal, maybe. Let's see. What class building is this? This is a Class C building, so you probably got a lot of evictions. Advertising, maybe. So we're going to leave all that the same and say that your NOI is $12,800 roughly. Because of the sheer volume of gross rents, according to them, that GRM multiplier, they're saying that you're getting $181,800 a year. Divide that by 12, you're getting $15,150 a month, $15,100 roughly, and divide that by 5, you're getting about $3,000 a month in rent per unit. We've already been over that, but let's split that up over 8 units. $1,887 a month. That's not too bad. So at 1.3, your interest rate is actually going to be closer to 6.999 on a DSCR loan. Your net cash flow is going to be $2,300 a month. On a bank loan, this would easily qualify even with the net operating income. Again, based on the numbers, there is something that would disqualify them for both, and that is the vacancies. You've got 3 vacant units. So you would technically not qualify for a DSCR loan nor a bank loan. DSCR loans allow a maximum of 2 vacant units, 4 or 5 units and up. And bank loans allow for 90% occupancy rates at minimum. So that means for every 10 apartments, you can have one empty. If you have an 8-unit building like this, let's pull up that calculator again. You have an 8-unit building and you have 3 units empty, you've got an occupancy rate of 62%. So this is not going to qualify for a bank loan. But even with the current vacancies, you could get $2,300 a month. So let's say we go hard money on this, right? 8.99%. Now you own the building, right? You're still cash flowing, believe it or not, even at 8.99%. You're still cash flowing, even if it's just $134 a month. Then you occupy that one unit at minimum. You try to get all the other units occupied, and then you either go bank loan at 5.875 or you go DSCR loan. And in either case, you can probably get, let's say you do a refi at if you do, to get 5.875, you'd have to buy down the rate. And that makes sense when you're purchasing the building because you could get the seller to pay for it in terms of seller concessions as part of the negotiations. But when you're refinancing it, the seller concessions come from you because you're the owner. So you're having to pay for those buy down points out of the equity you've already got in the building. So that's no good. So if you are going to do this, you can do it at 6.99% and get that $2,300 a month cash flow. But if you've got it 100% occupied, based on the equity you already put in, the down payment you already put into it, you can cash flow a lot better at $3,400 a month, $3,500 a month, just by going a normal bank loan. Now you can go interest only on either of these. Now you're going $5,000 a month on this building with the bank loan and $3,600 a month with the DSCR loan. But that's the way I would play this because it's cash flowing by itself already. And it's a pretty simple thing to see what this building would be worth in about 30 years and figure out that exit. I can do that for you right here. So $2.1 million. Let's keep it at 5.875 because you are going with the bank loan. You've got about 25% in there, I believe. What was it? Yeah, 75% LTV, 25% down. You're going to be fully occupied. $2.1 million, 8 units, and you're at 3030, I believe, was the gross rents. Again, we're going for fully occupied here, just get the bank loan. And let's see what the net operating income is. Landlord insurance was $733 a month. So that's about $8,800 a year. 733 times 8. Whoops. 733 times 12. 8,800. Legal, I left at $120 a month. Landlord insurance or property taxes at $1,784.06. No, that's property management. Property management was at $1,604. So let's see here. $1,561. So let's try to get this at maybe 7.5. What does that show for? Yeah, that's pretty good for property management. Property taxes, $63,000 a year. That doesn't make sense. $2,188. Oh, there's 3%, 1.25% right there. So now property taxes are correct. Let's see what we have for gas here. $20. $20. Water is 65. Water is 65. What do we have for electric? We have 80. 80. Nothing for lawn and snow. Trash is 250. Maintenance about $2,000. I have it at $22.30 here. It's at $2,005 over there. We'll choose a higher number. Advertising was $10. So your net operating your first year is $180,000, $500 less than the one we've done on the calculator. Net cash flow is $68,000. Net income, because of depreciation and mortgage interest write-off, is negative $9,000. So you don't even have to pay taxes on it for your first 2 to 5 years. Let's see what the exit would be at the end of the first year. You're looking at negative. You start being able to recover your interest on a sale. Your fifth year. The total return after 30 years is $18,420. That's pretty good. So you're getting a $2 million building, and after 30 years, you get to sell it for $18 million. This is a winner. This building is a winner, but the problem is the unoccupied unit. So you have to go hard money here. The play is go hard money, fill up those units, refinance into a bank loan. That's how you win on this.